I'm Anita Horza, Europe editor at The Banker, and we're here in Marrakesh for the IMF and World Bank annual meetings. And joining me is Janet Henry, Chief Global Economist from HSBC. Welcome, Janet.
Thank you. Pleasure to be here.
Janet, earlier this week, the IMF issued its sort of global economic growth forecast. And it sort of is predicting that sort of global growth will fall from 3.5% to 3% this year and next year. And it talks about a soft landing for the global economy. I just wanted to get your view on how optimistic are you about global economic growth?
Our forecasts are a little bit lower than the IMF's forecast. But it is interesting. Everyone seems to have this need to define any cycle as a hard landing or a soft landing. And sometimes forgetting that this has been an extraordinary cycle over the last few years with numerous events from the pandemic to the wars to huge geopolitical shifts. It was never going to be an ordinary downturn that fits any typical descriptions. So I wouldn't call our forecast a traditional recession or traditional hard landing, but nor is it a soft landing. We still are going to be in a disinflationary process for the next couple of years, and we still see growth below trend. We have a weaker downturn than the IMF, and indeed a softer recovery after that.
So, Janet, why is your economic growth forecast not as optimistic, perhaps, as the IMF's?
Well, monetary policy has been tightened quite a lot already. Central banks now think that they are restrictive. They're not super confident yet that it's definitely restrictive enough. They are prepared to raise rates again if they need to, but they are still well above their targets, and they've been above their targets for about 2.5 years. So even when you look at the Federal Reserve's forecast, they're not expecting to get back to target until 2026. So while we have a slowdown, it's not a deep recession, it's not even a traditional recession. We still see labour markets quite tight. We don't have a big rise in unemployment. We don't have a huge amount of easing, although we do eventually expect the Fed to cut rates in the second half of 2024. So that still means that growth is likely to be below potential, even in 2025 on our forecasts.
And what about China, this traditional engine of growth for the global economy? You're also predicting a slowdown there in China, below 5% this year and next year. How concerned should we be about China?
Well, it's been an interesting year for China, but also expectations regarding China. When China reopened at the start of the year, there was huge optimism because, of course, if we look at what happened in 2009 or 2016, it was when China rebounds, it floats all boats for the global economy, capital goods producers, commodity producers. And actually, you've got to remember, this was China's second reopening. They'd already reopened back in 2020. So a lot of the growth story has been somewhat sluggish. There are a number of structural challenges, in particular the local government debt issue and the issues in the property sector. But we have seen an array of policy measures gradually being rolled out, and there are some signs of revival in certain areas. Industrial production a little bit, some service sector activity, even some areas of credit growth, and within manufacturing investment, the auto sector and electrical machinery, you are seeing some improvement in manufacturing investment growth. But one, it's a different pace of growth because property isn't going to be supporting growth to the same degree, and the policy measures are designed to limit the spillovers from the property sector to the rest of the economy, but also a different mix of growth. As China tries to develop higher tech industries and become a little bit more consumer driven, it's a very different mix of growth for the global economy than when it was driven by 20 or 30% infrastructure spending and a very strong property market.
So if China's not the bright spot for growth, where is?
Well, China's already a much larger economy than it was when it was growing at a much higher rate. So it is still obviously quite important for the global economy. And that while that's weighing down some of the trade-dependent economies, Europe in particular, but even has led to some trimming of our numbers for the ASEAN countries, they are still rapidly growing. But our overall outlook for the medium term, so over the course of the next 3 years or so, is one of a shift in the global growth, inflation, interest rate trade-off. So compared with pre-pandemic, we have higher inflation, lower growth and a higher interest rate. So even with an easing cycle, we do not see rates going back to zero types of levels. But there will be some countries that do outperform and that may even be able to grow more swiftly than they did pre-pandemic, as long as they can continue their structural reform programme and where they have a comparative advantage in certain sectors. Obviously, there's a lot of optimism on India currently. So if they really can continue the structural reform process and ensure that what's being rolled out in the service sector, which is no longer just about call centres, a whole array of legal and design services and other business services, and really improving their digital infrastructure and raising their investment rates, we think that India's potential growth may have risen. Parts of the Middle East, Saudi Arabia and UAE, and actually Latin America. Brazil is one. Brazil's only grown at about 0.5% per year for the last decade, but they actually had some structural reforms in the last 5 years or so. And obviously Latin America is tied into the energy transition story. So there will be some relative bright spots, as well as some other Asian economies like, say, Indonesia, Vietnam, countries that are well positioned geopolitically and where they have a large domestic population and some comparative advantage.
Let's touch on inflation. Obviously a topic here at the World Bank meetings. Countries are at different sort of stages with their fight against inflation. But can we say that we're sort of out of the woods yet when it comes to the battle against inflation?
Inflation has come down a lot. It's come down across the emerging economies to varying degrees. They've all got slightly different stories. But even if we look at US inflation, you know, it peaked at over 9%. It's now back at below that 4% kind of level. But central bank targets are around 2%. And I think this is the big fear of central banks. It's one of inflation persistence. Not that it's going to go back to 9 or 10%, but that it gets stuck persistently above the 2% level, because it has already been above target for nearly 3 years and is set to remain so for the next couple of years. So they need to be really confident that disinflationary process is going to continue and doesn't permanently impact on price setting and wage setting behaviour and mean that it just becomes too sticky for too long.
Even though we've seen central banks in developed countries sort of pause their rate hiking cycle, if we see rates go up again, what impact do you think that's going to have on the debt burden of certain economies?
We actually think that the ECB and the Fed and the Bank of England actually have all peaked, but in order to stay on hold, they need to see the data come out in line with their expectations of inflation still coming down. But I think their key message has been that even if rates have peaked, they're going to stay high for some time. So in terms of the impact elsewhere, it will be anyone that's dependent on leverage will continue to feel the strain. We have seen rises in bankruptcies across Europe, across the US, in various areas of the corporate sector. That's where they're starting to feel it. In countries with variable rate mortgages, they are feeling a bit more pain. But again, you've got distributional effects, because even in the US, half of homeowners have no mortgage. They're finally getting some higher interest payments on their savings. But of course, there are countries in the world that are very dependent on external financing. They run budget deficits, they run current account deficits. And when investors can get quite a high return in the US with interest rates at these high levels, they're going to have to offer a higher premium in order to attract the funds, or indeed reduce their reliance on funding by really narrowing their imbalances, which does really weigh on their growth outlook. It absolutely hinges, it influences their own domestic policy, and they'll have to accept a weaker pace of growth, continuous structural reforms, and in some countries they'll also have to undertake some currency devaluations, and we're already seeing a number of them queue at the IMF for various degrees of programs.
Janet, thank you very much.
Thank you very much.